Okay, folks, let's begin the week ahead commentary with a look at earnings season thus far. I pulled this off of zerohedge.com, and this is earnings data released by Goldman Sachs, and it really illustrates where we stand thus far in terms of earnings, their quality, and revenue. As of this time, we've had 91 companies report out of the S&P 500 first quarter results, 28% of the S&P market capitalization. 37% of those companies have beaten earnings estimates below 47%. I'm going to send this out to you folks. I'm not going to read the whole thing, but let's just take a look at the charts. Percentage of companies beating earnings estimates. Thus far, this earnings period, we have seen a sharp decline in beats on earnings. Percentage of companies beating revenue estimates. Again, a similar chart. As a matter of fact, a worse chart than the earnings beats. Earnings are not up to expectations. Percentage of companies missing revenue estimates, huge, just an inverse of the other chart. So, in terms of surprises, sharp declines in earnings per share declines, average revenue surprise, big negative. We've gone negative on surprise, percent surprise on revenue. So 5 out of 5 charts negative and not implying a good earnings season thus far. That being said, this coming week is going to be like the canary in a coal mine. Why? It's due to the fact that you're going to have 33% of the S&P 500 announce earnings this week. Keep an eye on revenues. The analysts always guide lower on earnings so that companies can beat and the media can get everybody excited during earnings season. That's part and parcel. Let's go back to this chart here. Percent of companies beating on earnings. Look at the average. How could they be so wrong all the time? With the exception of this quarter. This is a bad quarter so far. So, not good so far. Big week next week, so stay tuned. Okay, in terms of economic data, last week, Empire Manufacturing Survey, market expectation 5.0, actual, big miss, 3.1. CPI, negative. X out, food and energy, a little bit of inflation, not much. This is going to keep the Fed with their foot on the pedal. Housing starts, first time above 1 million units in about 4 or 5 years. Building permits, big miss, 945,000 expected, 902,000 actual. Industrial production, slight beat. Leading indicators went negative last week. So, not a great week for economic data. This coming week, not much is set to be released. However, the announcements that are going to be released can move the markets, but really, earnings, they're going to trump the economic data. You're going to have durable goods orders, initial jobless claims, we get that every week. GDP for Q1, market expectation of 2.8% GDP growth. I'm not seeing it. I bet you that they miss on this number. Michigan Sentiment Survey, 72.4 expectation. Watch this number. This can move the markets. So let's move on to the charts. How did we look last week? S&P 500, we were down 2% on the week. We held the ever-critical 1550. There was no way that they were going to allow the S&P 500 to drop below 1550 the week before 1/3 of the S&P 500 announces earnings. That could all change this coming week. Declined on rising volume, above average volume. Slow stoch well below the neutral line. Slow stochastics rolling over. MACD threatening to go negative. But 1550, that's the line in the sand. Dow Industrials, weekly chart. Bearish engulfing last week. Held on to 14.5. Down on rising volume. Similar chart as with the S&P 500. The slow stochastics are rolling over. However, stochastic RSI holding up a bit better. than the S&P 500. MACD a little bit better as well. And for a while on Friday, this is a daily chart, the Dow Industrials were negative on the day, unlike the S&P 500, which was up most of the day. Dow Industrials really lagged on Friday, but eked out a gain. Dow Transports, daily chart, good reversal on Friday on light volume. So that tells me short covering. We do have good support here at 5,900. Note how your 50-day moving average is beginning to level off. Weekly chart, transports, big bottoming tails here. I wouldn't be a bit surprised to see us trade down to 5,800, but with a bottoming tail. They'll try to rally it off that level. Down on rising volume. Okay, the IWM, Russell 2000, of which we are short, using the TZA for new members. We managed to close above this resistance level here. Up volume on Friday was fairly good. It was a fairly bullish day. And I'm not going to be a bit surprised to see a counter trend move. Listen, my guess is that they pumped the markets higher on Monday morning to get ahead of earnings. IWM weekly chart, it's holding on to 90. You can notice all of these indexes are holding on to key support levels. If they break them, we're heading much lower. Big down volume last week. MACD went negative. So you have the Russell 2000 underperforming your large caps. No great shock there. Money flows continue to be negative. The banks, the financials, they had fairly good earnings, the ones that reported so far. However, the quality of the earnings is suspect. So just because they're announcing fairly good earnings, don't get surprised if you see them decline, like Goldman Sachs, because the quality of the earnings is just not there. Good volume on Friday. Let's take a look at the weekly chart, more important. Resistance at 1850. I really like to see this sector give way. Retail holders. I repeat myself every week by saying this. They never cease to amaze me. It continues to trade above the upper band of this rising uptrend channel. Consumer confidence came in horrible 2 weeks ago, as did retail sales, yet the retailers, they're showing relative strength. It's just incredible to me. The S&P 500 was down 2% last week. The retailers were down half of that amount. Daily chart, good strength on Friday. Let's check out the volume. Volume was average, nothing to write home about. Sloppy indicators here, really sloppy. Held on to the 50 level though, on the Williams percentage R. XLK monthly chart. This is the technology spiders. So far this month they are down 3%. We're going into the final week of the month, and it's just not a pretty chart. You have a bearish engulfing on a monthly basis. Not good. So they only have a couple more days to really shine. You do have Apple that reports this week. If Apple tanks, then it could quite very well be the death knell for the financials for this month. XLK on a daily chart. Good day on Friday. Reversed off of the lows, trading below the 50, 150, and 200-day moving averages. Never good to see. The semis weekly chart showed a little bit of strength last week. Inside week, did not make a new weekly low, did not make a new weekly high. So I would classify this as a consolidation phase here. We closed well off the lows of the week, down 1.24% on the week, which beats out the S&P 500. We were down on rising, down volume though. We might just see a double bottom here on the Williams percentage on a spike higher. So keep an eye on your semis because they could quite very well surprise and break out. Ooh, look at the utilities. What a move on Friday. Wow. Up 1.5% on the day. Check out volume. Big volume. Look at this ADX line. Folks, we're going to be looking to open up a short position. I said this last week in the utilities. We could have scalped the trade if we had the opportunity to get in on Monday. We didn't. It got away from us. However, good consolidation here most of the week. Breakout to new highs on Friday on rising up volume. This ADX line being above 60 is really a warning flag. It's on the track. Slow stochastics, very extended. Once these utilities begin to break down, I don't know what's going to keep this market up. I really don't. 30-year bond. Wow, look at this breakout. Closed above the 50-week moving average. Huge move last week. Just keep an eye on your ultimate oscillator. It looks like it's rolling over. A 10-year yield, a monthly chart. I said it last week. I think we're going to come down and test this lower band, the previous upper band of the pennant formation. I think this is now the lower band of its downtrend. I think we're going to come down, touch that, and probably pop off of it. Ultimate oscillator rolling over on this as well, which is not surprising at all. Let's check out the weekly chart, shorter term view. Yeah, this is not a good chart on a weekly basis. We gap below the 50-week moving average. And here's your divergence here. You have the interest rates that are declining, yet the S&P 500 up until last week was rallying. So scratch that. All right, 10-year yield on a weekly basis. The gap below the 50-week moving average, never good to see. It did reverse off of its lows, but not a pretty chart at all. The U.S. dollar, big recovery late last week, and herein lies a problem. If you have the U.S. consumer, which is retrenching and deleveraging, and you have a global economy where we become more and more reliant on our exports because the U.S. consumer is pulling their horns in, well, then the U.S. dollar becomes a problem. Now, up until the beginning of January, we had an inverse relationship between the U.S. stock market and the U.S. dollar since 2002. In 2013, thus far, that relationship has changed, and they now trade in tandem for the most part. So let's see how long that's going to last. If we have a retrenching consumer, we become more reliant on our exports. I don't see that this correlation lasting much longer, and it could quite very well hurt. What makes it beneficial having a stronger U.S. dollar is that commodities, because they're priced in U.S. dollar, become cheaper, especially oil. This is immediate tax relief on the U.S. consumer, which is good, freeing up some purchasing power. So I'm torn on, as a patriot, I'd love to see a strong U.S. dollar. However, relative to its effect on the market, I'm torn on it at this point in time. It really depends upon the U.S. consumer and the strength of the global economy. U.S. dollar on a weekly chart. Remember last week we had given up this upper band of the pennant formation. We closed back down below it. That was a breakout point failure. We recovered it last week with almost a bullish engulfing, beautiful top and tails, 82, which I said last week. was going to be support. They routed off of that level, and it looks like we are headed higher on the US dollar. That's my guess. I think it's a fairly easy guess to make looking at the chart. The VIX daily chart, big pullback on Friday. No shock after seeing these top and tails on Wednesday and Thursday. Let's take a look at the weekly chart more importantly. VIX on a weekly basis, big resistance here, 19.28. So we found resistance last week. I'm questioning whether or not it's going to head lower though. We did manage to close out above the pennant formation, this downtrend. We managed to close above that level, which is bullish despite the topping tail. West Texas Intermediate crude began to break down last week, undercut previous week's lows. I'm not going to be a bit surprised to see lower lows on crude. Down volume was fairly low though. Look at this choppy action we've seen this in the past 8 months. And we are rolling over on the slow stochastics. Very, very bearish Stokes, folks. Very, very bearish. MACD, very, very bearish. Nothing I like about this chart. I think oil's short right now. Okay, let's move on to the focus stocks video to see which stocks that we're planning on trading in the coming week and the status of our current portfolio. If you're not currently a member of the Contrarian Trader, please sign up for the 14-day free trial and get access to the focus stocks review, which is where we go over the current portfolio holdings and the stocks that we're looking to trade in the coming week that are on our watch list. So a 14-day free trial offer. Take advantage of it, cancel at any time, secure through PayPal.